Let's take a look at some information and charts on compound finance for Brave New Coin. So comp is part of the lending and borrowing trifecta, and the crown that is the jewel of DeFi. Very closely related to stablecoins, very closely related to leverage of any kind. There is a growing number of lending and borrowing protocols on most chains now. Maker, one of the first, Compound and Aave, close behind that, and now we have our third order or Web 3.0, I don't know, call them whatever you want. But Compound's been around for quite some time. And let's take a look at how some of this works. In general, for most of these protocols, governance will decide what tokens are available to lend or borrow. That's usually voted on by stakeholders. And we can look at individually in those markets, the supply and demand for each of the coins, and that will influence borrowing and supply, or borrow APYs and supply APYs, or lending APYs. If supply outpaces demand, then rates go down. If demand outpaces supply, rates go up. And this is highly fluctuating all the time. Most lending and borrowing protocols also have additional incentives, or at least some of them do, to lend on their protocols. This isn't clearly defined on comp that I can tell. Okay, so here it is. Here's the, I think, the distribution APY. Basically what I want to see is what is the base APY and then what is the additional bonus, the incentive for comp. I think this works out to 0.18. At least that's probably what they have. No, they don't. See, I'm not really sure. Maybe it's 0.02 on ETH. It's actually easier, funnily enough, it's easier to see this on other. Okay, here it is. So the net rate is this plus this. Okay, I'm just not looking at this correctly. But anyway, the net rate is the supply APY plus the comp distribution APY. And comp the token, I think, runs into some problems when you're giving a lot of people a lot of incentives to lend and make markets there. But it's sort of at the detriment of the token if the token is just being auto-sold or not held as it's getting distributed to users at a pretty high rate relatively. But as far as the markets go, they have quite a few. The big ones, all the stable coins that are important, along with BTC, ETH, some other DeFi stuff. And we can look at the lending and borrowing numbers to sort of determine how bullish or bearish things are, if things are out of whack. We can look at historic percentages of up and down days for supply and borrow. We can look at rates. We can look at all this stuff to get a rough idea of what's going on, assuming the protocol is neutral and there's no detrimental errors going on with the smart contract. So in the grand scheme of things, these APYs look relatively tame. They're certainly elevated from a few months ago, and are definitely above legacy rates, which are 2% or less, 0.05%, whatever it is on a savings account in a US bank. Here's their governance component. It's not going to move the needle for the token most of the time, but you can always dive deeply into this and see what's going on in the future, what's been voted on, how many people are voting, who's voting, all sort of interesting components to look at if you're interested in the governance aspect. And lately, even Mark Cuban is coming to bat for lending and borrowing, or DeFi. He mentions Aave specifically, probably because he has Aave himself, but comp is also similar to this. Looks like people are arguing with him about DeFi applications, and it's the typical, it's only used for gambling and illegal activities. And that certainly was the case early on. I mean, if we look at the Tron blockchain on DApp Radar, most of that is pyramid schemes, Ponzi schemes, MLM, or gambling. I mean, look at Satoshi Dice very early in Bitcoin's history. That's gambling. People love gambling. They're going to always love gambling. It's not a bad thing. It's just you need to move on from that eventually to sort of mature like DeFi has. And now it's just a different type of gambling. It's leverage trading or speculation. But in any event, he's saying it's much easier in 2 minutes. You can go to Comp, you can go to Aave Maker and take a loan. Boom, that's it. And you know it's collateralized and all that other stuff. And he goes on to say that, yeah, regulation is coming, and that's not the difference. I think regulation will have a high impact in the near term when it comes, which is coming eventually, right? Like he goes through saying it's fine, but at the same time, KYC AML of some type is coming for DeFi eventually. Right? I don't think anybody's going to be surprised by that. But that's part of the reason why it's so quick. It's because you don't need KYC AML. You can just pop in your wallet and you're good to go. So the narrative for DeFi is still strong. It's as strong as it's ever been. I think gas fees are affecting DeFi usage, along with just more chains, better chains, layer 2, bridging, blah, blah, blah. all that stuff is certainly impacting DeFi token prices. If we look at TVL across all chains, it's basically at all-time high effectively. If you look at Ethereum's TVL or dApps on Ethereum, that TVL is also effectively at all-time highs. Comp in here at number 5 at 12.26 billion TVL, and currently only on Ethereum. I don't think they have plans to go multi-chain. And if we look at this deeper though, this is sort of the argument against TVL and USD, because if we look at TVL on comp in ETH, it's actually down quite a bit from March, maybe 50% or less, slightly less than 50%, at 4.8 million down to 2.8 million. So sure, in USD it's at all-time highs, but you're just looking at ETH appreciation here for the most part. Now you'd have to dive even deeper and look at each market denominated in the underlying and not in USD. So look at the stablecoins, look at BTC, look at ETH, right? Yes, it's down against ETH, but that could also be in a relative basis. Everything else is just down against ETH. So unless you dig in deep, it's hard to really know what's going on here. Most people just stop at USD and they're like, okay, yeah, everything looks fine. But it's kind of more of that. Something else to look at would be percentage of stablecoin in each protocol, because as stablecoins increase in circulating supply, that's going to change TVLs across the board, typically because you're going to see more and more stablecoin in these lending and borrowing protocols. If you look at contract interactions and users, basically just flat. And one thing I thought was interesting, this is on DeBank, the 24-hour users for Maker is at 3,700. I don't know why, but when we look at Aave and Comp, it's certainly less. And you're going to want to look at this as a graph over time. This is obviously just a snapshot over the past 24 hours, but usually that's an indication of something is going on, some bot activity, or I don't see a lot of people getting super excited about Maker on social media, but maybe I'm just looking at the wrong circles. I assume this is yearn activity or something going on in the background. We can also look at market cap over annualized revenue as a revenue protocol, technically, that these things are. Comp is sitting here at a 5x multiple, meaning the market cap is 5 times greater than annualized revenue, as opposed to Synthetics, which is a 90 times multiple, meaning the market cap is 90 times greater than annualized revenue. And at the end of the day, I don't know that any of this stuff even matters. I've said this before many different times. I don't think TVL matters. Revenue doesn't seem to matter. TVL over annualized revenue, market cap over annualized revenue. I think we're still searching for a metric that matters. We can say that, yeah, it's better to buy stuff on the left side of the curve here. On all these charts, it makes more sense. But sushi's been on the left side of this curve for months, if not forever, and nothing's really happened since the bull market in January, February, and March. And you can really say the same thing about all these pairs. Regardless, Synthetics and Aave, to me, don't look any different despite having this disparity in PE ratio effectively. So it doesn't really pan out just yet, or it hasn't. That might change in the future, but it hasn't really mattered. If we look at on-chain stats for the token comp, transaction counts continuously pushing all-time lows here, slightly up from all-time low of November 20th. But this is not a good look for anything that wants to be bullish. Average transaction values should be rising across the board as ETH fees are relatively high. So nothing unusual going on there. NVT, which is an inverse metric of economic utility relative to price, has zero signal whatsoever. It is all over the place. We can even look at a 30-day average. Still doesn't really help. I mean, it's rising, so it's more bearish than bullish, but doesn't really tell you anything. Active addresses, though, pretty clear along with transaction counts, just continue to decline month over month since the pre-all-time highs, right? The bottom, the accumulation bottom, arguably, in late 2020 was when active addresses were their highest, and they've only gone lower since then. So if you're bullish on this, you want to see active addresses rising again. One other thing we can look at is MVRV relative to price. MVRV is a measure of market cap versus realized activity, similar to NVT. And when you map this against price for DeFi, it also doesn't really have a signal. Ideally, what you want to see is a high in MVRV corresponding with a high in price. But really, we haven't seen that so far. This may change. But again, this metric doesn't really matter. I wouldn't use this as a tradable metric. I'm still going to continue to look at this, but it doesn't really line up with expectations. For instance, the MVRV was at an all-time high when comp was 493. Comp went much higher than that later on. If I was following this strictly, I would be selling comp at 493 and buying it when MVRV is less than 1. And you can see here that I'm backtesting with an N of 2, right? This doesn't really work out for you so well. So right now comp MVRV is less than 1. So it's certainly more in the buy zone than the sell zone if MVRV is more useful at buying lows and selling highs. Flipping gears to technicals, this is the 5200 EMA yearly pivots, even though they really shouldn't be yearly because there wasn't a full year trading in 2020. But I'm going to look at it anyway, along with VPVR volume and RSI. If we look at what's happened post-May, we had this very bullish leaning series of patterns, chart patterns that ended up going nowhere. And ever since then, it's just been a death cross and good night. We tapped the 200 as a mean reversion and then just straight down, making lower lows after that, sitting on the R1 yearly pivot, sitting below a bunch of volume here. So this is not a good look for anything if you want to be bullish. You want this to be back above the 200. You want a bull cross. You want a price to eventually break 480. We are very, very far away from that on this chart. We're definitely closer to downside support than breaking out of 480 at this point. So as this leans on trend, it's not bullish. The volume profile is not bullish. It's not exactly down and out just yet. You do have a bit of a bull div here. You have a lower low in price, higher low in RSI. So as bad as this looks, I wouldn't consider it just mega bearish. It's still technically within the range that's been in since May. It just doesn't look bullish leaning at all. Cloud also telling you it's below the cloud with a bearish TK cross. The expectation here is not higher highs. The expectation currently is lower lows is bearish continuation until it's back above the cloud at around 380. So also, again, on trend metrics, doesn't look good. Against BTC, it's also pushing lows. Does have a multi-week bull div. It is at the bottom. And basically, this is it. It's either going to bounce or die here. Cloud doesn't like it. It says it's bearish. It's below the 200. It's below the previous range. Really, the only thing it's got going for it is a potential Adam and Eve chart pattern or W double bottom. But other than that, there is very little hope that this thing bounces at this level. And against ETH, it looks even worse. Probably bad enough to buy because it is continuously breaking all-time lows. It has a multi-month bullish divergence building here. And it just looks like there's no hope. It looks like there's no hope in sight. It's also got a declining volume profile. So momentum is slowing at these levels. That isn't to say it's going to auto bounce here, but it does have a potential to mean revert to 0.3, which would be a 2x from here. 0.3 or 0.13 is also the previous two lows in January and June. So you certainly wouldn't be buying this with bullish expectations. It would only be mean reversion fodder, basically. Beyond that is a bonus. So the classic case of I love the protocol, I use the protocol, it's great. The token is having a rough go over the past few months, especially ever since it got denied at that 480-500 level. It's really had a hard time doing anything substantial since then. Lastly, let me just mention the ETH BTC fund and DeFi portfolio I trade for Techemy Capital on Enzyme.finance, a non-custodial portfolio management tool where you can send ETH or USDC or just watch what I'm doing. You can see everything including AUM, performance, allocation, some vaults I'm in here on Yearn Comp and Aave, as well as the trades I make in the trades tab down below. That's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.